trying new things, sometimes there's fear, kind of like being assigned on spreads. When you write options, which means selling them, within a spread, that means you have protection. These options are at risk of being exercised by the buyer. That means they will be assigned to your account. And the portion in a bear call spread that will be assigned to your account will be the short call. Because they give this to you in short shares, you have to buy them back. So today I want to focus in a little bit deeper on short calls. So when looking at something like Microsoft, we see that we have resistance, and we just came into resistance. Looks like a great place to sell the news. It's been a very long time since we've retested it. Right now, Microsoft's trading at $303.57. So we like that we're up against resistance at these levels, but we're going to define our rules a little bit more. So when figuring out where we're going to sell our strike price for the call, we know that Microsoft moves in a $5 strike price. So we have 300, 305, 310, or 315 to choose from. If we choose the 300, that means we would buy the protection of 305. If we sold the calls at 305, we would buy the protection of 310. If we sold the 310, we would buy the protection of the 315. If price is in between our spread trade, we will be assigned. If price skyrockets over our spread trade, we will lose 100% of the value. And we've seen many times when price comes into this resistance, it doesn't always just stop on a dime and fall off. Sometimes it goes down a little bit, then right back up, making higher highs. Sometimes it just goes straight up higher, falls off a little bit, and make higher highs again before coming back down. So the strike price that we're going to pick to sell the calls is really important. Either this 300, 305, 310, or 315. The problem with picking these higher ones is because price isn't up there right now, it's not going to just get you automatically into the trade. If you pick the 315, you'll have to wait for price to go all the way up here to get you into the trade at a 1-to-1 ratio. You could take this trade at a 75% risk to 25% reward right now, but that's not the way we trade. So little rule that's always good to follow is make sure that the bottom strike price is at or above where you're currently trading. So that means Microsoft is trading at 305. If this is the call that I'm selling, which is always the lower number because we're buying the higher number for protection, then 300 is under 303. So I have to go to the next strike price up, 305. To be at or above the current stock price. We're on this side of the option chain, the bid, we press that, comes up red because we're selling. We have a $5 apart spread, so for a 1-to-1 trade, we need to have price at $2.50. And we understand that because we're asking the market to go up a little bit. Because remember, price is at 303, and we need it to go to 305 to get us into the trade. We're not going to wait, so we're just going to raise this price up to 250, and then we're going to put in a GTC and walk away. If it gets us in, great. If it doesn't, great. So now here's the order. 2,500 risk, 2,500 reward. Current stock price is 303. And this says our break even is 307.50. So throughout the trade until expiration, if you are under $307, this trade will be profitable. If you're over $307.50, it means that the trade will be negative, which is great because that puts you up around here. So if you go over the $307.50, this will make the trade a little bit negative. If you start moving 10% higher, it will make the trade more negative. This is the 0 point of your prosperity. If it's a little bit under that 0 point, you'll make a little bit of money. A little bit more, you'll make more money. Further it goes down, the closer it gets you to 100%. Now let's see what would have happened if you would have took the lower strike price under where the value of the trade is right now, 303, and take the lower strike price of $300. Click on the bid side, comes up red. We still have a $5 spread, which holy moly, they give you a better risk to reward. Before it was $2,500, now it's $2,200 risk, saving $300. Max profit was $2,500, now it's $2,800. The money that you would have spent here on your risk now flops over to your profit. But you notice this right here, your break even is $302.80. So as soon as price comes under that number, you'll start making a profit. But you remember what it was before up here, meaning right right here you would be making profit instead of down here. The other thing is now you're selling the call at 300. In order not to be assigned, price has to close below this at expiration instead of our first trade that we saw at 305, meaning price would only have to stay below this. So when making a rule, appreciate your money. And you see all these trades right here are for open. Macy's, $23 is the lower strike price. I'm at a $1 spread, so I put it at 50 cents, giving me a 1-to-1 risk to reward. This is a good one to point out. Right now, Eli Lilly is at $264.50. So our closest strike price would be $265, but we don't have that as an option. So if we went under our 264, that would put us at 260, meaning the price would have to go very low in order to get us into the trade. Since I like my money better than that, I'm going to go to the higher strike price of 270. So by expiration, the price only has to stay below 270 and I'll capture 100% of my profit. We have a $10 spread, and so I have just a little bit under a 1-to-1 ratio at $4.90. If I get in, I get in. If I don't, I don't. And by the looks of it right now, I won't get in because I'm so far off what the option makers are giving me. But that's okay. JNPR, $29.24. So we're just going to pick the $29 one, right? Wrong. Because it's at or over. Right now, price is at $29.25, and $29 is under that value. We can't pick this trade. We have to pick the higher one, $30. So we're selling the lower value, $30. We're buying the higher value, $31 for protection. It's a $1 spread, and so we're going to go 50 cents. GTC. Here's another good one, EU, $118.17. So if we just grab the money, that would be $115, which is way below our current value of the stock. We like our money too much, so we're going to go to the higher strike price of $120. Sell the 120s, that's why it's red. Buy our protection of $125, $5 spread, so we're going to sell this for $2.50. GTC, and we wait. And out of this big list, you can see I want to get in at just under $5, and right now it's at $4.40. No big deal. Here's an interesting one. I don't know why it didn't get me in. I'm at $2.50, and it says current price right now, $2.90. So we wait. I'm at $1.25 on a $2.50 spread, and right now price is at $1.12. I just wait. I do nothing. It doesn't bother me. Almost $5 and it's at $2.50. Oh well, I look for the next trade. $2.45, $2.35. It's close, but I'm not going to change my price. I'm up against resistance with a great strike price. If Monday doesn't get me in this week, I'll just cancel the trade on Friday. KR up against resistance. Either it gets me in or it doesn't. Some of my trades like TJ Maxx and LC filled, along with Charter, ADSK, and Microsoft. Here we are, LC up against resistance. Let's look at a smaller time frame. So this is when I priced the trade before the open, just under $29. I sold the 29 calls, and that's what I mean. Price had to come up into that higher strike price to get me into the trade. Now it went past that, and that's okay, but that's why I picked the 29 to sell and the 30 for protection. I hope this little rule helps of always picking a higher strike price than the current stock price.